Okay, good morning. Happy Friday. Because you guys just want to learn theoretical stock valuation. Okay. Any questions so far? We're running a little light. I actually have to, I now need to start writing down again. Okay, any questions on what we've covered so far? Anybody having problems on anything? I know Excel has been fun. I'm getting good Excel questions. And again, we did I think for the first time got to walk through some Excel build last time, which is what I wanted to do for one of the classes that I had to cancel. So again, if there's a desire or a need to go through Excel or how to build an Excel, kind of an Excel template to be able to try and work through some of the stuff in the class, let me know. I'm likely to do at least one session in an evening at some point between now and early April to go, okay, here's kind of an Excel tutorial ahead of the final exams. But I think most of you, if you haven't figured it out by now, you're either really struggling, or you've managed to come up with some methodology that is working for you. But again, I figured I would do that just as an assist, because the final is going to require you to be quite well organized, and we'll walk through how to, later. We'll walk through the final exam. But I'm going through it right now with my JBLM students, and there's a little bit of stress. So I just want to kind of give you some heads up ahead of time. Any questions on what we covered Wednesday? 7. That's a pretty typical JBLM class size. 7 to 13, 7 to 14. Okay, so we're going to start working math today, or at least theory today, on the items that are driving theoretical stock price. And again, when we think about theoretical stock price, it's like the value of any financial asset, which is what? How do we determine the value of any financial asset? It's 2 components. What are the 2 components? The value of any financial asset has 2 components, and I say it every class, but I decided you guys are going to start saying it every class. First thing is what?
Principal value. The value of future earnings.
The value of any financial asset. Say it. Yes, expected future cash flows discounted at an interest rate or a discount rate. And that interest rate or discount rate reflects what? The risk. Beautiful. The value of any financial asset is the expected future cash flows discounted at a discount rate. And that discount rate is reflective of the risk associated with those expected future cash flows. Memorize it. The whole final, that's everything we're doing. That's all it is. It's over and over again. It's just, let's take this asset and look at it. Oh, what is it? It's the expected future cash flows discounted at a discount rate. How do we come up with a discount rate? How do we come up with cash flows? Stock, amazingly enough, is exactly the thing, except it's got its own nuances, but it's, what are the expected future cash flows of this stock? What discount rate should we use? Mush the 2 together, come up with the present value, and that's the theoretical stock price or stock value. It may not be the stock price. And when it's not, That's when you know to buy or to sell because you've got an arbitrage opportunity. So let's talk about what those components of expected future cash flow are. Because unlike a bond, which is a little bit easier because you've got a maturity date or a call date that says, okay, I'm getting my money back. So you've got a start date, which is today. You've got an end date, which is at some fixed point in the future determinate that they've said, okay, you're getting paid back. And you've got cash flow periodically in between. Stocks don't have a maturity date. And the cash flow in between is higher risk. Why? Because it's a dividend. And what did we talk about last class as it pertains to dividends? They're not required to be paid. So dividends might be paid, they might not be paid. They have to be declared by the board. And until they're declared by the board, they may not be paid at all. And even when they are declared by the board, we talked about they could be undeclared depending on if there's a subsequent event that causes a company to struggle in their performance. So let's talk about the various components of cash flow modeling. Dividend. That's a dividend expected, and see expected is in italics because it's not for certain to be paid at the end of year T. Dividends are generally paid quarterly. So pay attention, as I've talked about, the biggest problems we'll have in this class, and the biggest problems you'll have in reality, is kind of taking the word problem or the situation and pulling out the pieces of it to stick into an equation. Notice that here it's at the end of year T. Normally dividends are paid quarterly. Pay attention to see the frequency of the dividend payment in whatever problem you're trying to work. Price T is the expected price of the stock at year T. Now that's interesting because we're sitting here going, we're trying to project an expected future value. And we talked about future value as well in chapter 4. We're trying to project a future value because we're essentially creating a maturity. P sub 0 is the actual price of the stock at year T because you're likely to have a difference between expectations and reality, almost always. And if you haven't experienced the difference between expectation and reality in real life, God bless you. G, expected growth rate in dividends. There's some question when people go through growth rate that they're looking at expected growth rate in the company. The two are probably related because for dividends to grow, the company's profits generally have to grow. However, remember, we're focused on cash flow. And so growth is the expected growth rate in the dividends. And so you have to, if it says the growth rate of the company is X, and they're expected to keep their dividend flat, don't get caught up in, well, the expected growth rate is X, so I'm putting that in. It's the dividends. And R sub S is required rate of return on the stock. So the sub S is really the stock. And this is your discount rate. So what you really have are the components of expected future cash flow, growth in cash flow, this goes to that, and then the discount rate. It's the same stuff over and over and over again. And as soon as you begin to master, or as soon as you've mastered the math, it's pretty straightforward. These are a couple of formulas that, well, I say you don't have to memorize formulas, you sure as heck need to understand the concepts behind these particular formulas because you can't calculate a stock price without them. The first one is the expected dividends during the coming year. Now, D sub 1 is the expected dividend in the future. Price sub 0 is the price today. So you're looking at an expectation over a price. So you've got a future value and a present value here. And that can trip folks up. Here's the capital gains piece. Remember in bonds, we said there's a capital gains component as well. So you got the return and interest rates that's with the periodic interest payment. And you've got the change in the price. So if you bought it at a discount, you've got a gain. If you bought it at a premium, you may have a capital loss. Same thing with the stock. This is the expected price 1 year in the future, in this particular case, sub 1. Current price. So this is the gain over the current price. Just like a bond, stocks have two components to return. Cash return, capital gains. So this is what you get when you sell. This is what you get in cash periodically, just like a bond. The difference is with a bond, this is known because it's a maturity amount. With a stock, it's expected because you don't really know what it's going to be. With a dividend, it needs to be declared, so it's expected. With a bond, it's, unless there's a default, it's known because the interest needs to be paid, otherwise you defaulted on the bond. But as a practical matter, for the math, it's the same stuff. You just need to understand that we're always looking, in case of stocks, we're looking one period in the future. And then R sub S is the expected rate of return during the coming year, which is this yield plus this yield. It's essentially the total return. How much you're making in terms of capital gains, as well as how much you're making from cash that comes in the form of dividends. Any questions on those things? All right. This is the general model, or the general way of thinking when it comes to stock investing. If the expected rate of return, R hat sub S, is greater than or equal to the required rate of return, R sub S. So notice expected, just like in statistics, normally your expected has a little hat on the top. So that's a projection. So if the expected rate of return on something is higher than your required rate of return, you buy. Because if the expected rate of return is higher than the required rate of return, the price is going to be what? Higher or lower than you would be willing to pay? Lower. So remember, rate of return and price are inversely related. So if rate of return is higher, price is lower. So that means the price is going to be lower than what you would expect to pay as well. A good investment, required, or the expected rate of return is higher to or equal than required. Bad investment is just less than required. If it's required, if it's equal to, you're saying, okay, that's still a good investment. Because you factored in the risk as part of the discount rate in this rate of return, required rate of return, you factored in the risk that it's actually not going to achieve the expected rate of return. So if it's guaranteed, it's risk-free. And if it's got a risk component associated with it, you're going to factor that in to the calculation or to the determination of your required rate of return. So you can look at it in terms of, and the way we're looking at it here, in terms of required rate of return and expected rate of return. Or you can look at it as, I'm willing to pay this price, because again, these are inverse. If the price is lower than what I'm willing to pay, then I'm going to buy. If the price is higher than what I'm willing to pay, I'm not going to buy, or I may even sell short, which means you're going to borrow the stock, sell it, and buy it back later at a lower price. Any questions on this concept? It's pretty straightforward stuff. This is the classic risk return calculation that you use to buy or sell any financial asset. Stocks are valued on a basis of dividends, cash flow. Remember, all we care about in finance is cash flow. How much money is going to come into my pocket? And so when you look at a stock, there's no maturity, right? There's no, okay, the company ends at this date, 99.99999% of the time. There's no maturity. There's no known end date for the company. And so when you're looking at the value of a stock, all you care about is cash flow. You're never going to get the purchase price back unless you sell the stock. And if you sell the stock, someone's buying the stock, and they're buying it, in theory, based upon the same valuation method as you sold it. And so when you look at it, the value of the stock, it's really the value, the expected future cash flows on a stock is the value of the dividends from the security zero today. The next dividend payment to infinity. So we're going to calculate to infinity and beyond. So you've got essentially a timeline that is really difficult to build in Excel because you have to go out to infinity. And so you're like, okay, well, that's great. How do I calculate an infinite set of dividends? And that comes down to a couple formulas that I will generally call a dividend growth model. So again, you're looking at expected dividends as the basis for stock values, current dividend, rate of return on the stock, discounted back will give you the price. That's the value of the stock. It's expected future cash flows discounted at the required rate of return for the stock gives you the price. The value of any financial asset is the sum of the expected future cash flows discounted at a required rate of return will give you the value. The bonds look exactly the same. Stocks look exactly the same. Rental real estate will look exactly the same. Any model that we look at for a financial asset will look exactly the same. Expected future cash flows discounted back at a discount rate. The discount rate reflecting the risk. So you've got a couple different ways to calculate the growth rate. To calculate how stocks are valued. Because all we're focused on is the dividends, which becomes a little challenging. And we're going to talk about a couple of these challenges. But I'm going to ask you a question. You guys all have computers. You can look it up. Tell me what the current dividend rate is for Amazon. How much did Amazon pay in dividends last year? Your guess is 0. What's the current stock price for Amazon? Let's look it up. So Amazon stock is currently selling for $1,486.91 a share. It's moving. Amazon is worth $719 billion. Get out your checkbooks. Dividend. There's no dividend. So what the heck? How do you get a valuation of $719 billion, almost $720 billion, no dividend, when I just stood up here, pounded on the table, and said the value of any financial asset is the expected future value of the cash flows, which are dividends in the case of the stock, discounted at a certain rate of return. How do you reconcile that Amazon is worth $720 billion? It doesn't pay dividends and has never paid a dividend.
They can say, like, we're not going to pay dividends because we're going to reinvest it in the company and do more stuff with it. And people are, all right, so this they get more revenue.
But all I want is cash flow. Where am I going to get my money? Well, the guy who's buying it, when's he going to get his money? And the woman who buys it then, when's she going to get her money? Some of these rapid growth technology companies make it very difficult to use finance theory because they don't I will tell you, I own no Amazon stock. I'd be much wealthier if I did, if I had bought it back when my friends all ran to Amazon in 2000, because they were still hiring, about the only company in Seattle that was. But I wouldn't buy it because there's no dividend, no prospect for a dividend. They're never going to pay a dividend. What theory would say, what the Mad Hatter professor will say, is that there's an expectation of a dividend at some point in the future. So when Amazon stops its rapid growth, so the answer is generally correct. What they're saying right now is we can reinvest that money, and we can grow the company even faster, and we can build you more value. And at some point, we're not going to be able to do that, and we're going to start paying dividends. We're going to mature, we're going to be sitting on lots of cash, and we're going to start paying dividends. Microsoft was one of those companies. Grew. No dividends. And then about 10, 12 years ago, they paid a massive dividend, like $20 a share, $18 a share in dividends. And then they started paying dividends because the company matured. So they started sitting on a bunch of cash. So the theoretician will say, it's expected future cash flow. It might not be in the next 2, 3, 4 years, but we've discounted that. We put it out, 0, 0, 0, 0, 0, 0 for the next 10 years, and then we start with big dividends. And when we discount that back at the required rate of return, we're coming up with $1,420 as the value for Amazon per share. The practical person in me says Amazon is way overvalued, hasn't made enough cash to support itself, and I don't know how the hell it continues to function that way. Although I've spent enough at Amazon that I probably could stay alive with people like me for a while. But as a stock, I don't know why it's a good investment. In theory, this is why it would be a good investment. As they're saying there's going to be dividends paid, it's just down the road. That makes sense? One of the hardest things to get our heads around is this split between theory and practice. Because you look at the theory of finance and you go, Amazon shouldn't be worth anywhere near what it's worth. If you operate on that point, if you operate with that mentality and you don't buy Amazon stock, or you sell Amazon stock short and it continues to rise, you get blown up, or you'll certainly have left money on the table. So the analysis is going to hold for Amazon just like it would hold for anybody else. The dividends are expected future cash flows. It's not current cash flow, it's not prior cash flow, it's expected future cash flow, and in theory, it's in there. So we're going to talk about constant growth model. Constant growth occurs when a company gets to a maturity point. So when a company has kind of gotten to a place where it's growing 2, 3, 4% a year, it's not seeing this rocket ship growth. It's not like Amazon where it's going to grow, and then slow down. This is one where you go, okay, it's linear growth, and it's going to be relatively constant. And what we're going to try and analyze, again, this is the point at which the growth is going to be about at the same rate of the economy. The growth of the dividends is going to be at the same rate as the company. And we express that in terms of a dividend growth model. The valuation, again, you're going out to infinity. And so you can't build that in Excel. It goes out a lot of cells, but it's not going to go out that far. Although, as we all know, what's the present value of this amount? What's the present value of $1 2,000 years from now? How much is that worth to you? Nothing. So as you go further and further out, the parts you're adding up approach zero. And as a practical matter, once you get out 30, 40, 50 years, the value is almost zero already on almost any reasonable nominal amount. And so you go out to infinity and you go, okay, it approaches zero. So we've got a formula which essentially allows us to calculate it close enough because it truncates out all the zero. And that formula is the expected value of the next dividend payment over the required rate of return on the stock minus the growth rate. And these are both expressed in terms of percentages or decimals. If the growth rate's really high, so let's say the required return on the stock is 12%, and the growth rate is 10%. What does this become? What's the denominator? If the required rate of return on the stock is 12, the growth rate on the dividends is 10, what's this become? 2%. The lower this number gets, what happens to the price? The higher the price gets. Because your numerator, this isn't a decimal, right? This is, so the bigger this decimal, the closer this decimal approaches 0, the closer this approaches infinity. And so as a result, if you have a high growth, you're going to have a high price. And that's when you look at something like an Amazon. It's got a high growth. It may have a higher required rate of return, but it's got a high growth associated with it. And so you're with this at 0, 0, 0, and then all of a sudden you start picking up stock down here, or you start picking up cash flows down here. At the end of the day, this becomes a big number because the growth rate is rapid. So as dividends are going to grow 10% a year, there's a lot of value associated with that. So the two things to remember when you're looking at the dividend growth model, constant growth model, areas where you tend to get tripped up is you're looking at the next dividend payment, not the last dividend payment. A lot of times, the information you have available to you, whether it's in the real world or in class, is it'll tell you, company X paid a dividend of $2 a share. The growth rate is 10%. Calculate the expected value of the stock. The required rate of return is 12. The growth rate is 10%. The number you're going to use is $2.20, not $2. It's the next dividend payment. So don't get tripped up. That's just a kind of on a math piece. Expected next dividend payment over required rate of return minus growth rate. Yes, ma'am.
Does that mean you use like that last one, the growth rate, and then
yes, you can use $2 times 1 plus the growth rate, which will give you times 1.1, which will give you $2.20, which is the expected next dividend payment. So these are equal, but if you've got the $2, don't put $2 here. Otherwise, you'll get the wrong answer, and it'll probably be one of the choices. So here's graphs because I like graphs. Here's a dividend starting at $1.60 with 5% growth rate, constant growth rate. You can see that going up and to the right. That's the cash flow. So the cash continues to get bigger and bigger and bigger and bigger because it's growing constantly at 5%. However, the present value is going down. So the required rate of return on the stock is 20%. You've got a 5% growth rate. Even though the cash is going up, and out here, it's going to be significant. It's significantly higher than $1.60. It's going to double every 12 years. The present value is lower. The present value continues to go down because required rate of return is higher than the growth rate. So right now it's saying, given this calculation, the value of that stock today, it's the area under the curve, or $11.20. You're essentially summing up all those expected future cash flows. And that's done formulaically using that formula there. And like I tell you, I don't like you guys having to memorize formulas, but you sure need to know this concept. There's no Excel function that
does that because you're going to infinity. So you need to kind of be able to build that formula out. It's not a difficult one. If growth equals 0, so in a state where growth equals 0, the company is flat. It's the current dividend, because again, we're measuring the growth in dividends, right? Not the growth in a company, growth in dividends, it's the current dividend. Or if you said plus, if you want to use the same formula as before, and you plug 0 into each one of those components, you're still going to get the same answer. It's the current dividend over the required return. It's a very simple formula. You don't need to have this one separate, because if you just plug zeros in, this essentially is showing what would happen if the zeros are canceled out. If you have a zero growth company, if you have a no growth company, it's a current dividend divided by the required rate of return. And the required rate of return is going to be something more than 0, because as a matter of fact, the required rate of return might start getting higher and higher. Because if the company's not growing, there's other risks. What other risks might you see with a company that isn't growing? What concerns might you have if you're investing in a company that's not growing? Say again? Yeah, your money's not making money. And so you're going to have to build that money making money into the stock price. So the price is going to go down. What other risks? Just practical matter. If a company's not growing, what's it doing? Yeah, there's a maxim in business that said you're either growing or you're dying. So a company that's not growing, unless they've got this cool little niche market that they've kind of got, they're in a monopoly situation where they've cornered the market isn't growing, the market is steady, and the company is just steady, which is a pretty rare thing in reality. If they're not growing, they're probably on, if you look at, kind of a curve of life, and the thing goes up and then it goes down, and you're seeing a 0 on your first derivative of that growth curve, that means you've hit the peak. And unless all of a sudden this thing starts taking off again, you're more likely to see a decline. So you've hit a 0 growth period, and if in this particular case you're expecting that future growth is at 0, that's pretty unrealistic. It's a practical matter. You're either growing or you're dying. So if you see a company with a 0 growth rate, and you're using this formula, and you're looking at it as an investment, or you're in it as a manager, you need to ask yourself, am I growing or am I dying? If I hit a plateau that I'm going to head up on, or if I hit kind of the top of a curve, and at this point we're going to be going downhill, because that's going to impact your required rate of return. And so you should never really, in practice, see a 0 growth rate for an extended period of time. And when you see a company with 0 growth rate for a couple of years, you really need to dig into that company and make the determination whether they're growing or dying. Whether they're making a strategic shift and they're going to start to grow again, which is what they'll always tell you, by the way, or whether they're really on the decline and it's just hasn't happened yet. The expected rate of return on a constant growth stock is the next dividend over the current price. So that's your dividend yield, plus your growth rate or your capital gains yield. It's pretty simple math. Expected rate of return, again, isn't equal to your required rate of return. Expected rate of return is the expected dividend yield and the expected growth rate. The required rate of return may be higher or lower. That's based upon what you require based upon your risk analysis. If the expected rate of return is higher than the required rate of return, what do? You buy. If the required rate of return is higher than the expected rate of return, you do what? Sell or don't buy. And that's how you deal with money or theoretical stock price on a constant growth stock. Now we're going to talk about Amazon. Valuing stocks with non-constant growth. Non-constant growth means that you've got a company that's growing rapidly and slows down, or has hit that plateau and is going to take off. How do you think, without necessarily looking ahead in the slides, how do you think you would value a company with non-constant growth? How do you think you'd value a company with non-constant growth? So you got a company that you think is going to grow at 12% for 4 years, at 10% for 3 years, and then at 5% to infinity. How would you approach that problem? If I said, dividend equals $1, find P sub 0.
Would you value the attributes?
Yes, you're absolutely right. Here's what you would do. Yeah, you'd say, okay, I've got 4 years, year 1, 2, 3, and 4. And I value this at 12%. And I come up with a expected price at year 4, future value, discount it back. Then I've got years 5, 6, and 7 at 10%. So I take this dividend, what it was here, I grow it out at 10% for years 5, 6, and 7. I come up with a P sub 7, and I discount that cash flow back. And then I go, okay, the rest of this is out to infinity. I can figure out what the value is here based upon this going out to infinity at 5%, and I discount that back. And then I sum this up. The present value of that, and that gives you the theoretical stock price. You essentially break it up into component parts. And you come up with the present value for each component part, and you sum the component parts up. And so right now with Amazon, you'd be in this 0 dividend chunk, and it may be 10 years long. But some future point in time, there's going to be massive dividends, obviously, because it's valued at almost $1,500 a share. And so those massive dividends would come out in kind of that second phase to infinity. From massive dividend to infinity is a big number. And then we discount that back to today. So there's an expectation at some point, theoretically, that those dividends are going to be paid. We discount that back to today, and that's the value of $1,481.61. Step 1, compute the dividends that are expected to be paid during the non-constant growth period. You can do it, the growth can change year to year. It doesn't matter because you're just calculating, okay, what's the dividend? Present value. Dividend, present value. Dividend, present value. Sum it up. Continue computing dividends until you compute the last dividend that's affected by non-constant growth. And at some point in the future, I'll get there. At some point in the future, you have to assume constant growth. You have to assume that at some point the company hits stability. Yes, ma'am.
Would it be considered non-constant growth if it's like, just like your example going from 12 to 10?
Yep.
That would?
Yep.
Although it's declining?
Yep.
Okay.
Constant growth is defined as from that period to infinity, the growth rate is unchanged. So from the point that the growth rate never changes again, for the purposes of the calculation, is a constant growth rate period, and you use the last formula. For any period between that, you can have negative growth periods, you can have, it's whatever the calculation is, discounted back. So you could have multiple non-constant growth periods. You could have a non-constant growth period in one period. There could have been, for those first 7 years I put up there, each one could have been a different growth rate, a different dividend amount, and a different present value. And all you're going to do is sum those up. You're going to use the required rate of return for the stock as your discount rate for determining the present value. All you're going to do is add the present values up of each, and I've got an example here. You're going to add each of those present values up. Then you're going to take the sum of those present values and the sum of the terminal present value of the constant growth rate period, which is always going to be at the end. And that's going to give you your theoretical value for the stock. I realize this looks clear as mud, so I'm going to show you an example. Here's an example. Compute the non-constant growth rate, non-constant growth dividends. Dividend for period 1 is $1.20. Dividend for period 2 is $1.44. Dividend for period 3 is $1.73. So you just go, okay, what's the present value of this? What's the present value of this? What's the present value of this? Sum it up. That's the present value for the non-constant period. Then again, you've got a second component, which is after those 3 years, you now have a constant growth rate of 5%. So it grew at 20% for 3 years, right? Bang, bang, bang. And then we go, okay, now it's going to be constant from year 4 at 5%. So we take that year 3 times 1 plus the growth rate to get our year 4 dividend, right? That's here. We take our required rate of return minus the constant growth rate, which is $18.14. And that's at year 4. That's the present value at year 4, or basically at the end of year 3. Then we're going to discount that back. So the present value of the constant growth period is $11.93. The present value of the non-constant period was $3.27. You add those two together, the non-constant period, plus once it converts to a constant period, you add those two together and you get a valuation on that stock of $15.20. Don't let it psych you out in that you're going, oh my God, I've got all these periods, I've got all these present values. I don't just take each dividend and discount it back to today. Each dividend discount it back to today. Each dividend discount it back to today. And when the dividends stop changing and it says, and then the growth is constant at X%, come up with the present value at that point and discount it back to today. Add it all together and you come up with a theoretical stock price or with the expected or with the present value. I recognize that this is conceptually sometimes difficult to grasp. But if you take a step back and think about it the way that we've been calculating everything in class, this is one that you can put in Excel. At least this first piece. All you're calculating for this first piece is you're going, I've got a cash flow, a cash flow, a cash flow in each one of those periods. And the problem said it's growing at 20% a year. Okay, cash flow, cash flow, cash flow. My discount rate was given, required rate of return is given 15%. Just do present value. What's that? It'll give you that number. Then you've got a second piece to the word problem. And then the company grows at 5% in perpetuity or 5% constant growth. So you go, okay, what's the dividend value at that point? Oh, it was $1.96. You go, okay, I'm going to take that number. I'm going to do my constant growth formula. And that gives me a present value. that present value is in year 4, or is the fourth cash flow. So just add that into the same calculation. Okay, I calculated that out. Now I've got 4 cash flows. I've got 1, 2, 3 is my dividend 1, dividend 2, dividend 3. My 4th cash flow is coming off that formula for constant growth. Put that in for period 4. Then calculate present value on that in Excel, and it'll give you $15.20. Don't get beyond the fact that all we're trying to do is calculate the present value of expected future cash flows. And it's really how we get to that number, what the inputs are. In this case, it's a non-constant growth period of 20% for 3 years, and then 5% forever. You really have 2 pieces. Any questions on this before I let you go for the weekend and we dig into a little bit more of this on Monday, and I'll probably do an example or 2. Okay, thanks very much. Have a great weekend, and I will see you all on Monday.
Do you have an office hours on Wednesday next week?
Wednesday, let me look.